I think that Morgan Stanley, being the first big U.S. bank to take this step to file to launch its own ETFs, is a huge endorsement. So we've started to see this comeback of institutional cash just in the first few trading days of the year. Finally, the surge in spot Bitcoin ETFs, which were net outflows for the last few months of 2025. And what this really signals is that Morgan Stanley, for one, has been the most progressive.
Earlier this week, Morgan Stanley made history. The Wall Street giant announced filings for Bitcoin, Ethereum, and Solana ETFs, becoming the first major U.S. bank to take that step. Within minutes, crypto Twitter erupted. Analysts, influencers, and investors alike framed it as a watershed moment, an institutional endorsement so powerful it should have sent prices soaring. Bitwise advisor and crypto analyst Jeff Park went as far as calling it the most bullish thing ever, arguing that it proves the crypto market is far larger than even insiders previously believed, especially in its ability to attract entirely new classes of customers. And yet, the market barely moved. Prices didn't surge. There was no euphoric breakout, no sustained rally, just a muted reaction that left many investors uneasy. To understand why this feels so strange, we need to rewind. In early 2024, before the approval of spot Bitcoin ETFs, Bitcoin was trading near $40,000. After approval, and in the months that followed, prices more than doubled, closing the year at a new all-time high near $90,000 per coin. So, today, with even more powerful institutions lining up, a critical question emerges. If big banks and institutional money are supposedly so bullish for crypto, why have prices been so underwhelming? That's the question we're breaking down in today's video, and the answer may be more unsettling than you expect, because this story doesn't begin with Morgan Stanley's ETF filing. It goes back to October 10th, to a violent liquidation event, and to a web that allegedly connects MSCI, Binance, MicroStrategy, BlackRock, and yes, even Morgan Stanley itself. Before we dive in, please like this video, subscribe to the channel, and turn on post notifications. Now, let's get into it. The first tweet we'll examine comes from Bull Theory, a widely followed crypto research account on X. What follows is speculative, but deeply provocative. The tweet opens with a bold question. Did Morgan Stanley pull off the biggest crypto manipulation? According to Bull Theory, the sequence of Bitcoin's October crash and its January recovery looks less like coincidence, and more like a carefully engineered setup. It all begins on October 10th. That day, MSCI, a company that originated as a Morgan Stanley division, announced a proposal to remove digital asset treasury companies from its global indexes. This included firms like MicroStrategy and Metaplanet, companies holding billions of dollars worth of Bitcoin on their balance sheets. This wasn't a technical adjustment. MSCI indexes guide trillions of dollars in passive investment flows worldwide. If these firms were removed, pension funds would be forced to sell index-linked ETFs, would reduce exposure, institutional Bitcoin allocation would shrink, liquidity would dry up, fast, and the market reaction was immediate. Within minutes of the announcement, Bitcoin plunged nearly $18,000, wiping out over $900 billion from the total crypto market cap. This wasn't panic selling from retail. This looked structural, and that was only the beginning. What made this event even more damaging wasn't just the crash, it was what followed, because the proposal didn't end on October 10th. It stayed open. Bull Theory points out that the MSCI consultation period lasted until December 31st, creating a 3-month overhang on the entire crypto market. During this window, uncertainty ruled. Passive investors hesitated. Index-linked funds faced potential forced selling. Institutions stayed on the sidelines. Prices remained suppressed. Sentiment collapsed. Over that period, Bitcoin fell roughly 31%. While altcoins were hit even harder. What followed was the worst quarter for crypto since 2018. Nothing new had broken. No catastrophic regulation. No major exchange collapse. Just uncertainty, hanging over the market like a loaded trap. And then, suddenly, right as the year flipped, everything changed. On January 1st, Bitcoin quietly started climbing. In the first 5 days of 2026, BTC surged 8%, rising roughly $7,300, from $87,500 to nearly $94,800. There was no major announcement, no ETF approval, no macro catalyst. Yet selling pressure vanished. Green candles stacked back to back. Bull theory suggests the obvious question: who was buying and why? Then came the reversal. Between January 5th and 6th, everything snapped into place. First, Morgan Stanley filed for spot Bitcoin, Ethereum, and Solana ETFs. Then, just hours later, MSCI announced it would not remove crypto-heavy companies from its indexes after all. The exact rule that triggered 3 months of selling pressure was suddenly withdrawn. Same players, same week. Perfect timing. Bull theory lays out the sequence plainly. October 10th, MSCI threatens index removals, crypto crashes, and demand freezes. Prices remain suppressed for 3 months. Morgan Stanley files its ETF, MSCI cancels the removal threat. The implication? Create pressure. Accumulate at lower prices. Launch the product. Remove the pressure. Profit from the rebound. According to the thread, MSCI controls index inclusion, while Morgan Stanley controls capital distribution. Together, they don't need to predict markets. They can shape them. There is no official confirmation that this was coordinated, but the timing, the sequence, and the beneficiaries raise real questions. And if this interpretation is even partially correct, then the October crash wasn't random volatility. It was structural. This brings us to a pattern many traders have noticed, but few have been able to explain: the now infamous 10 a.m. Bitcoin dump. According to multiple reports, this pattern began emerging in November and, remarkably, appears to be ongoing to this very moment. By mid-December, the phenomenon had become so consistent that CNN published a report addressing it directly. They described a strange and increasingly familiar rhythm. Just as U.S. markets open around 9:30 to 10 a.m. Eastern Time, Bitcoin often experiences an abrupt sell-off. In minutes, hours of gains disappear. Then, just as mysteriously, prices stabilize or even recover later in the day. And no, according to the data, this isn't imagination or cherry-picking. Since early November, Bitcoin has fallen within the first U.S. trading hour in more than 60% of sessions, often dropping between 1% and 3% in a matter of minutes. On December 4th, for example, Bitcoin fell 2.1% in just 18 minutes, even as the S&P 500 opened flat, offering no macro explanation. But one incident in particular reignited the debate. On December 15th, Bitcoin plunged roughly $3,200, falling from about $89,800 to $86,600 in under an hour. There was no breaking news, no regulatory shock, no geopolitical catalyst. Yet the move triggered over $200 million in long liquidations across major exchanges. Crypto research account Bull Theory captured the moment bluntly, tweeting, "Breaking. Bitcoin dumped $3,200 from $89,800 to $86,600 and liquidated $203 million worth of longs. All this happened in the last 60 minutes with no major negative news or FUD." Another example of 10 a.m. manipulation, which happens almost every time the U.S. market opens. Crypto really needs a market structure bill. Bull Theory also reports a more recent case of the 10 a.m. manipulation in a January 6th tweet, which reads, "10 a.m. manipulation continues. Bitcoin has dropped $3,000 and liquidated $220 million worth of longs in the last 3 hours, $80 billion wiped out from the crypto market. While Dow Jones hit a new all-time high today and precious metals are near all-time highs, this is truly insane." Again and again, these sharp, sudden moves aligned almost perfectly with the U.S. market open, raising uncomfortable questions. Is this manipulation, algorithmic trading, or simply the growing reality of Bitcoin becoming tethered to Wall Street's daily rhythm? So the question naturally follows: who is actually behind this relentless 10 a.m. pressure? Once again, we turn to Bull Theory, who published another eye-opening thread attempting to connect the dots. The tweet opens with a question many traders have asked in frustration. Why does Bitcoin always dump at 10 a.m. when the U.S. market opens? Bull Theory points out that on the day in question, Bitcoin erased 16 hours of gains in just 20 minutes immediately after U.S. markets opened. Yet another example in a pattern that has repeated dozens of times since early November, and, notably, also appeared in Q2 and Q3. This isn't a new phenomenon. According to the thread, Zero Hedge has been calling this out for months and has floated one name repeatedly as the most likely culprit: Jane Street. When you zoom out and examine the charts, the pattern becomes difficult to dismiss. A sharp sell-off within the first hour of the US session, followed by a slow, methodical recovery later in the day. Bull theory argues this resembles classic high-frequency execution: fast, precise, and short-lived. And most importantly, it fits Jane Street's profile. One of the largest high-frequency trading firms in the world. Deep liquidity, the ability to move markets for minutes, not hours, without needing sustained follow-through. The alleged behavior is described as almost mechanical. Dump Bitcoin at the open, push price into liquidity pockets, re-enter at lower levels, repeat. Bull theory claims that by exploiting this structure repeatedly, large players may have quietly accumulated billions of dollars worth of Bitcoin. As circumstantial context, the thread notes that Jane Street currently holds roughly $2.5 billion worth of BlackRock's IBIT ETF, making it one of their largest positions. Again, there is no public confirmation that Jane Street is deliberately manipulating Bitcoin. But the consistency of the timing, the precision of the moves, and the scale of capital involved have made this theory impossible for many traders to ignore. But it doesn't stop there. Because allegations of coordinated selling don't just point toward trading firms, they also implicate major crypto exchanges and institutional desks. On December 18th, the account 0xNobler published the following tweet: "Breaking here's why, crypto just dumped again. Binance sold 7,106 Bitcoin. Wintermute sold 6,500 Bitcoin. Coinbase sold 7,437 Bitcoin. Fidelity sold 6,659 Bitcoin. Bitstamp sold 6,459 Bitcoin. They dumped over 2.5 billion Bitcoin in just a few minutes. This was a coordinated manipulation." Less than 3 weeks later, the same account issued another warning after a similar crash on January 6th, breaking the exact reason why Bitcoin just crashed. Binance sold 9,635 Bitcoin. Coinbase sold 6,766 Bitcoin. Paxos sold 6,757 Bitcoin. Galaxy Digital sold 4,050 Bitcoin. Wintermute sold 2,808 Bitcoin. They dumped 3.55 billion Bitcoin in 45 minutes. This was a coordinated manipulation. The implication is obvious and deeply unsettling. Multiple entities, massive size, extremely short time windows, and once again, no major negative news. Now, it's important to pause here. Large Bitcoin movements from exchanges and institutions do not automatically prove collusion or manipulation. Some of these flows can represent ETF rebalancing, custodial transfers, internal liquidity movements, or hedging activity tied to derivatives markets. But here's the issue. When these events cluster around the same time of day, trigger mass liquidations, repeatedly punish leveraged retail traders, and disproportionately benefit large liquid players, the market stops feeling organic. And that's why this debate keeps resurfacing. Because whether intentional or structural, the outcome is the same: price suppression during key liquidity windows, followed by quiet accumulation. And that leads to the final uncomfortable question: is Bitcoin being manipulated? Or is it simply evolving into a market where only those with size, speed, and structure can survive the volatility? Few companies have felt the pressure from this entire debacle more directly than MicroStrategy, now rebranded as Strategy and led by Michael Saylor. For months, Strategy's stock traded under a cloud of uncertainty, not just because Bitcoin was volatile, but because of a very real structural threat. Had MSCI gone through with that change, Strategy could have been reclassified as an investment-oriented entity rather than an operating company. Because exclusion from indexes like the MSCI All-Country World Index or MSCI Emerging Markets Index wouldn't have been symbolic. It would have triggered forced selling from passive funds, potentially totaling billions of dollars. Analysts estimated that Strategy alone could have faced up to $2.8 billion in mandatory outflows. When MSCI finally confirmed it would not exclude digital asset treasury companies, Strategy's shares surged immediately. Clear evidence that the damage wasn't about fundamentals, it was about structure. And MicroStrategy wasn't alone. Any firm building long-term exposure to Bitcoin through public markets, including crypto-related equities and treasury-style vehicles aligned with investors like Tom Lee, was caught in the same crossfire. This wasn't about bad bets or poor execution, it was about how index rules, passive capital, and institutional mechanics can quietly pressure entire sectors long before retail ever understands what's happening. That's the real lesson of this cycle. Bitcoin isn't just fighting volatility, it's navigating a financial system that's still deciding how, when, and if crypto-native companies truly belong. And understanding that difference between price action and structural pressure is what separates reaction from conviction. If you want clear-eyed analysis instead of surface-level narratives, if you want to understand why firms like Strategy get punished before they're vindicated, and if you want to follow this market with context, not emotion, then like this video, subscribe to the channel, and turn on notifications. Thanks for watching.